Hey there, folks. Welcome to another exciting episode where we break down the complex world of finance into bite-sized, digestible pieces. Tonight, we're diving into the wild world of mortgages. Yes, those hefty loans that make the dream of owning a home possible for many. Specifically, how that mysterious entity, the Federal Reserve, plays a role in how much you pay every month. It's not just about signing on the dotted line. There's a whole orchestra of factors at play. The Fed, as the cool kids call it, is like the conductor of the U.S. economy. They set the tempo, ensuring everything runs smoothly and in harmony. They don't set mortgage rates directly, but their actions have a huge impact. When the Fed makes a move, the ripples are felt across the financial world. Think of it like this. The Fed is like that one friend at a party who always controls the music. They set the vibe and everyone else follows. They might not be telling you dance, but their song choice definitely influences your mood and maybe even your mortgage rate. When they play a fast song, everyone dances energetically. When they slow it down, the mood changes. The Fed's main job is to keep the economy humming along smoothly, and they aim to strike a balance between growth and stability. They do this by controlling the money supply, which is essentially how much money is sloshing around in the economy. It's a delicate balance, like adding just the right amount of seasoning to a dish. Too much money and things get out of control. We're talking runaway inflation, where prices skyrocket faster than a SpaceX rocket. Imagine going to the store and finding that everything costs double what it did last week. Too little money, and the economy stalls out like a car with a dead battery. Businesses struggle, jobs are lost, and the shelves in stores start to look a little bare. The Fed walks a tightrope, trying to find that sweet spot where the economy grows at a healthy pace without prices going bonkers. It's a constant balancing act requiring precision and foresight, and one of their main tools for doing this is something called the federal funds rate. This rate influences how much banks charge each other for overnight loans, which in turn affects how much you pay for your mortgage. So next time you think about your mortgage, remember the Fed's role in the background, orchestrating the economic symphony that makes home ownership possible. Now let's talk about this federal funds rate thing. It sounds boring, but trust me, it's more exciting than watching paint dry. Slightly more exciting. Basically, the federal funds rate is the interest rate that banks charge each other for super short-term loans. Think overnight loans, like when one bank needs a little extra cash to meet its reserve requirements. The Fed sets a target for the federal funds rate, and banks use this as a benchmark for all sorts of other interest rates they charge. So when the Fed raises the federal funds rate, those overnight loans between banks get more expensive, and guess what? Those higher costs get passed along to you and me in the form of higher interest rates on things like credit cards, auto loans, and yes, even mortgages. So we've established that the federal funds rate affects short-term interest rates. This is the rate at which banks lend to each other overnight, and it serves as a benchmark for many other interest rates in the economy. But what about those long-term loans, like your precious 30-year mortgage? You might be wondering how a short-term rate can influence something that spans decades. Well, it's all connected, my friend, like a chain reaction of financial dominoes. The effects of the federal funds rate ripple through the entire financial system. When the Fed raises the federal funds rate, it's like giving that first domino a good hard push. This initial push sets off a series of events that affect various interest rates, including those for long-term loans. The rising short-term rates ripple through the financial system and eventually influence those long-term rates. Investors and lenders adjust their expectations and strategies based on these changes. Lenders know that if they can earn more money by parking their cash in short-term investments, they're going to charge more for those long-term loans, like mortgages, to make it worth their while. This is because they need to compensate for the opportunity cost of not having their money available for other investments. It's basic supply and demand, really. When the cost of borrowing money goes up, the supply of available funds for long-term loans decreases, and lenders need to be compensated for the increased risk and reduced liquidity. When the cost of money goes up, lenders want to be compensated for tying up their funds for a longer period. This means higher interest rates for long-term loans, including mortgages. So those long-term interest rates, including mortgage rates, tend to follow the Fed's lead, even if it's not a direct, immediate relationship. Over time, the influence of the federal funds rate trickles down, affecting the rates you see when you apply for a mortgage or other long-term loan. Section 4, Expectations, the market's crystal ball, and its impact on rates. Now, here's where things get really interesting. The relationship between the federal funds rate and mortgage rates isn't always a simple case of Fed raises rates, mortgage rates follow. Sometimes the market anticipates the Fed's moves like a bunch of fortune tellers trying to predict your next Tinder swipe. See, the financial markets are constantly buzzing with speculation about what the Fed will do next. Investors, economists, and market analysts spend their days poring over economic data, trying to get inside the Fed's head, and when they sense that the Fed is about to raise rates, they often start bidding up interest rates in anticipation. It's like a self-fulfilling prophecy. The market expects rates to go up, so they start acting accordingly, and those actions can actually influence the Fed's decision making. It's a wild world out there, folks. Section 5, Treasury yields, the government's borrowing spree, and your mortgage. It's a topic that might seem distant, but it has a direct impact on your financial life. Let's talk about another piece of the puzzle. Treasury yields. These yields are a crucial part of the financial ecosystem. Treasury bonds, also known as T-bonds, are essentially loans that you and I make to the U.S. government. When you buy a T-bond, you're lending money to the government. The government issues these bonds to raise money for various projects and expenses, and in return they promise to pay us back with interest over a specified period. Now, the interest rates on these T-bonds, known as Treasury yields, are influenced by a whole bunch of factors, including, you guessed it, the federal funds rate. This rate is set by the Federal Reserve and plays a pivotal role in the economy. When the Fed raises rates, investors often demand higher yields on T-bonds to compensate for the risk that inflation might eat away at their returns. And here's the kicker: this isn't just about government finances. Those Treasury yields play a big role in setting mortgage rates. The connection might not be obvious at first, but it's very real. Lenders see those yields as a benchmark for long-term interest rates, and they often price mortgages accordingly. This means that changes in Treasury yields can directly affect how much you pay for your home loan. So when Treasury yields go up, mortgage rates tend to follow suit. This can make borrowing more expensive for home buyers, impacting monthly payments and overall affordability. Understanding this connection can help you make more informed financial decisions. Section 6, MBS. Wall Street's mortgage gamble and why you should care. Hold on to your hats, folks, because things are about to get really wonky. We're going to talk about something called Mortgage-Backed Securities, or MBS for short. Don't worry, it's not as complicated as it sounds. Basically, MBS are like giant bundles of mortgages that are sliced and diced, then sold to investors. These investors are essentially betting that those homeowners will keep making their mortgage payments. And guess what influences those investors' appetite for risk. You guessed it, interest rates. When interest rates are low, investors are hungry for yield, so they're more willing to buy up those MBS, even if it means taking on a bit more risk. But when interest rates rise, investors get a little skittish. They demand higher returns to compensate for the risk, and that can drive up mortgage rates.